We're joined tonight by Mr. Andrew Kim, who's just a total killer, a lot smarter than I am. He's been in the game a long time, running Davis investments and developments and syndications, breaking into the Sacramento market, learning a lot. So he's been a wealth of knowledge for us and just a great connection, great guy to have around. So we appreciate you joining us, Andrew. Thank you. So we're going to go ahead and pass the mics around. If everyone just wants to briefly introduce yourself, your name, where you're from, what you hope to contribute to the group, what you hope to take away from the group. Just a quick little introduction, and then we'll hand it off to Andrew, who's going to chat for about 20 minutes, maybe, about some interesting market cycles. And then for the rest of the night, the music starts, and we can all just hang out. So thank you guys for coming.
Yeah, so this is actually my fiance, Taylor, in financial services, works for American Fidelity. So I think I met many of you before. My name's Andrew Truman Kim, and I want to start off with a huge thanks to Noah and Sean again for hosting us, and for all of you for joining us to help strengthen our real estate investor community here in Sacramento. So just show of hand, who's been in Sacramento for the last 5 years? All right, nice. How about 10 years? 10 years?
Guys are welcome to
okay.
find a seat, get comfortable.
How about 20 years? Okay, super OG. Well, yeah, so I've been here for 20 years now too, since 2005. I actually started working in the state capitol in 2006 for the lieutenant governor, Senator Don Parada, then worked in Congress. Actually, in 2013, I was the only Asian campaign manager for a U.S. congressman. And but in 2015, I left government to do real estate. And a lot of it was because my mom had health issues and I needed to make more money. I loved working in government, but I left in real estate and did real estate development, real estate investing, completely changed my life. In less than 10 years, I went from 0 properties to now owning 50 rental units. Most of the rental units are in Davis. And, from now I manage, I help realize over 30 million in real estate investment value and currently actively manage 17 million in asset value. And I keep thinking, like, there's nowhere else in California where I think my story would have been more possible than in Sacramento. And so I think Sacramento is such a special place, this area, and so happy for you all being here. So today's talk is really about how do we approach deal analysis and market analysis. And I'm excited to talk to you about deal analysis. A lot of people think, oh, deal analysis is about having, the deal calculator, right? A lot of people who've been to the Bigger Pockets website, they have a Bigger Pockets deal calculator. But it's really not about a deal calculator. It's about the deal calculation process. Because if you have just a deal calculator, it is one-dimensional. Like when you are analyzing a deal, there is a deal calculation process. And so here's the punchline. The process that we use in my firm, Gateway Equity Partners, Gateway Development Company, and Kim Capital, we have 3 steps that we do to analyze deals and markets. Step 1 is ascertain accurate numbers. Step 2 is stress test those numbers. Even if you have the numbers, if you don't battle test those numbers, then you are not doing yourself a service. And then number 3 is compare those returns with other returns from other assets, other market classes, other strategies. Okay, so for step 1, ascertaining accurate numbers, there's 4 types of numbers that you need to have a clear understanding on your spreadsheet. So number 1 is bottom line, top line, bottom line numbers, then key assumptions, and then key performance indicators. So top line, number 1, deal cap rate. What is the deal cap rate? And that's just really, the NOI divided by, the cap rate or purchase price. And so the deal cap rate is important. What's the interest rate you're getting, right? If you're doing seller finance, creative finance, that's very different. If you're doing conventional loan, agency loan, what have you. And the main 2025 insight that I'm getting from all of my mentors and very successful institutional investors you need to make sure that your deal cap rate is higher than interest rates. right? So if interest rates right now, conventional is at 6.8, your deal cap rate needs to be 6.9, right? Or at least 6.8, because if you're not at least neutral, then you're going to be in big trouble. And a lot of the folks who are distressed right now, even though they were positive cash flow, they were actually negative leverage. And so the number one insight in 2025 is you want to be neutral leverage or positive leverage. So that's top line number, cash on cash. That's also a top line number. But then we're also looking at bottom line numbers. So what is your yield on cost, meaning exit cap rate, right? And you need to make sure that your yield on cost is actually higher than your deal cap rate, right? So if your deal cap rate is 7%, your exit cap rate or your yield on cost needs to be at least 7.5 or 7.2, right? Or just at least higher than 7. Otherwise, it's not a good deal, right? But then you're also looking at any equity multiples, right? Or your internal rate on return, which I'm going to cover in just a moment. Now we're talking about, so once you have your top line numbers, bottom line numbers, now you want to make sure you have your key assumptions locked in, right? So key assumptions, number one, what is the market cap rate? And market cap rate used to be really tough to find. Now you can chat GPT it. So it's insane. So you find out what the market cap rate is, find out if your operating expenses, the assumptions that you're using to underwrite the deal, make sure the operating expenses are very conservative. Make sure that you can get real-time quotes from contractors, real-time bids from lenders, real-time understanding of what insurance costs. Don't just guesstimate, right? And then, of course, rents. Making sure that whatever rent projection that you're having, that it's conservative again. And you should check real-time rents. Don't just kind of, oh, I've used these rental numbers before. You want to have very clear understanding of the neighborhood of the market of what you can get for rents. And then, of course, vacancy rate, right? A lot of people are way too aggressive on their vacancy rate. So those are key assumptions. And the punchline there is just be conservative. If you're talking about really good underwriting, it just means be conservative on your key assumptions. If you're conservative on your vacancy rate, where you're like at least 5%, if not 10%, right? OpEx, a little bit higher than what it probably is. Rent, a little bit lower than what it is. Right off the bat, you are protecting yourself, your investors, your family, and your entire business. Then lastly is the key performance indicators, right? And that is, what is the likeliness of rent increasing in your neighborhood, right? What is the likeliness of you being able to achieve 100% occupancy? What is the appreciation rate of your property value in your neighborhoods? What is the amortization rate? What's the depreciation? And all of that combined together is really how you get the IRR. And so here is numbers that I've looked through a lot of deals in Sacramento. As Noah mentioned before, of my 50 rental units, it's actually 12 properties. And of the 12 properties, 8 of them are in Davis and 4 of them are here in Sacramento. But I've analyzed a lot of deals in Sacramento, and here's what a typical deal return looks like for Sacramento on an IRR basis. Annual cash on cash, we're looking at anywhere from 4 to 6%. And it's not high, but it's because if you go to Stockton or you go to Fresno, you can get way higher. But here in downtown Sac area, we're good with 4 to 6%, knowing that appreciation annual is 2.5 to 3.5%. Amortization, meaning that if you have a 30-year fix and a tenant is paying down the principal for you, that's another 1.5 to 2.5%. And then depreciation rate, anywhere from 2 to 4% return. So an annualized IRR in Sacramento is anywhere from 12 to 17%. But the main thing about these returns is that it is all contingent upon your deal strategy. And here's the punchline, is that why is deal strategy important? Because the reality is this, there's always good deals out there in every asset class, in every market, as long as you are able to accept and mitigate the risks associated with that deal. Number 2, that it is aligned with your larger portfolio vision. And number 3, that you are ensuring sound and viability on your deal hypothesis. So if your deal hypothesis is sound and you're able to accept the risks and work through the risks, and this is part of your portfolio vision, then there's always a good deal to be had. And so that's why I believe, as much as understanding the numbers are important, also important, if not more important, is actually going to be understanding your deal strategy. But before I go into deal strategy, let me just finish again the process, deal calculation process. So number one, ascertain the numbers accurately. Number two is stress test the numbers. So 3 tests that you do: sensitivity analysis, move the interest rate. So move the interest rate on your underwriting 30 basis point to 50 basis point. See what happens to the deal if you move it 30 to 50%, 30 to 50 basis points. You'll find it shocking on how just 30 basis points can completely tank your deal, right? And so that means your deal is very interest rate sensitive. Also, test the key assumptions. Try to decrease the rent by 2 to 4%. See what happens to your deal, right? Or try to increase your operating expenses by 3 to 5%. See what happens to your deal. So that is doing that sensitivity analysis. Anyone who's doing a deal and they don't provide that sensitivity analysis, it means they haven't done their due diligence, right? And when you're underwriting your own deal, you need to do that sensitivity analysis as well. Then number 2 is you're doing feasibility analysis, meaning for the actual deal that you're going to invest into, what is the viability of that business plan? Is there clarity in the business plan, in the operation plan, of the realization rate? And then, of course, you're doing a gap analysis. What could be missing in the business plan to achieve the returns on what is being projected? So ascertain the numbers, stress test the numbers, and now you're comparing the rates, right? And so your whatever returns, and I just mentioned 12 to 17% IRR, whatever. I mean, that is here in Sacramento. The moment it goes to Stockton, 12% for me is not good enough in Stockton. I need to see like 18 to 20% if I want to be in Stockton. Or in Fresno, I need to see 20% plus if I'm going to be in Fresno. So by the market class, it could already change. By asset class, those returns are going to relatively be changed. And then, of course, is strategy. What is the strategy you're using? Based upon the strategy, your returns may not be good enough. So in certain strategies, 12% IRR might be good. Certain strategies, 12% is not good, right? If I'm doing a fix and flip and all I'm getting is 12%, not a good deal, right? So here are the 6 strategy frameworks to consider. So number 1 is the level of value add you are going to do. The level of value add is completely changes on what the deal ROI should be. So are you doing no value add? So that's what we call turnkey, right? So turnkey is great because you don't need to do any value add and you can start renting it from day one, get cash flow from day one. Or you can do light value add, right, to force appreciate a little bit. Or you could do heavy value add, or new construction is essentially heavy value add, or upzoning or rezoning, or all these different ways. So that completely can change the expectations of the returns. Then number 2 is the state of the deal. Are you buying this deal distressed, or is it non-distressed, right? So if it's distressed, it could be usually one of the 3. So financially, it's distressed. It's foreclosure, notice of default, notice of trustee sale. I know many of you are learning how to source those deals. Or the building is distressed. It's fundamentally dilapidated and needs to be heavy value add. Or some other reason, probate, code violation, some legal lien, or what have you. So then 3rd is financing strategy. Is it conventional financing, lender or agency, or is it non-conventional? Is it creative financing where you're doing buying it subject to, or seller finance, or master lease, or lease to buy? Operation strategy. Are you self-managing it? Are you outsourcing the property management? Are you doing heavy management like short-term rentals? A tax strategy. Are you buying and flipping, right, within less than a year? Or are you buying and holding? And if you're buying and holding, are you doing buying and then cash out refinance? Or are you buying to pay off the loan? Or are you buying to recycle the profit? There's 5 different exit strategies right there. And then, of course, tax strategies. Are you doing straight line depreciation, accelerated depreciation, bonus depreciation? The U.S. Senate just introduced their bill, version of the Big Beautiful Bill. It's going to make bonus depreciation permanent. That would be insane. Yeah, permanent bonus depreciation. The Big Beautiful Bill is also going to add $4 trillion to the deficit. But real estate investors, this is a good time to be a real estate investor. Okay. And then each of these strategies that I mentioned, right? state of deal, value add, financing, operations, tax, exit strategy. All of them can have tremendous implications when it comes to your ROI expectations. Are you getting single digit returns, double digit returns, triple digit? The ROI timing, are your returns going to be short term, midterm, long term, or is it risk on or risk off? And so now for market analysis. So when people, or at least for our firm, when we do market analysis, the 10 traditional factors that we look into are this. So number one, when we look at a market, we look at private equity investment. And this also was really tough to look at now with AI and ChatGPT. Oh my gosh, the data that you can get to see in any of these communities where venture capital funding is coming, where angel funding is coming from, where institutional capital is going, right? So private development, right? So for example, the UC Davis Aggie Square or the Kaiser, right? The hospital and the rail yard. That's $1 billion investment into North Sacramento. And same with the UC Davis Innovation Center, $1 billion investment in private equity. And then business growth. How much more business expansion, business relocation? How many businesses are moving to Sacramento? Then job growth, right? And so, for example, the Aggie Square project is going to generate 20,000 jobs and 5,000 ongoing jobs here in Sacramento. Then population growth, then public investment, so government investment from city, county, state. Then we look at quality of schools, crime rate. Then we get into neighborhood curb appeal, walkability, and amenities. So those are the 10 traditional factors when you're thinking market. But for me personally, after doing being very market judicious, the most important factor that we look for are what we call the X factor. And the X factor is the fundamental constraints of new supply coming into the market. That is the most important factor we look for now. And we're realizing because if there is no constraint and a developer can come and build 1 million new units in 2 years, then now you are competing against this unlimited new supply. And that is going to hurt your rent growth. It's hard to compete with that. That's why we're looking for markets that have fundamental land use policy constraints, political constraints, government constraints, or topographical limitations like coastal cities. There's like only so many places. We're in mountaintops. There's only so many places you can build, or environmental constraints. And so case in point, Austin, Texas. This year, the last 2 years, Austin, Texas was the 5th fastest growing metros in the US. There are dozens of tech companies that moved from California into Austin. However, because there was no fundamental supply constraint and they allowed developers to build 100,000 new rental units in less than 3 years, essentially these units cannot be absorbed. As of now, rents have dropped 10 to 15% in the city of Austin. Right, so if you're a landlord and you have to drop your rents 10, 15%, it means every year you've been doing rent increase for 3% every year. Now you have to drop it 10, 15%. You're in distress, right? And also, property vacancy levels are up to 15%, and these units, the values have dropped significantly. So that's a case in point where even though the 10 traditional factors, tech companies are moving in and all of this stuff, they don't have fundamental supply constraint. And that's why that market is in trouble. And that is why I love Sacramento. Because Sacramento, there is fundamental supply constraint here. And that's why I definitely love Davis. Davis definitely has supply constraint. And so here is my ending conclusion. In conclusion, my number one recommendation for folks who are getting started is before thinking about doing serious deal analysis, because there's 1,000 different potential permutations on developing a strategy. It's so important that you first develop your strategic guideline, or what we call your investment thesis. Because once you have your investment thesis on which of these strategies you're going to employ, essentially you are creating a lens, your goggles of how you're going to do deal analysis. And without the goggles, the deal calculator from Bigger Pockets is not going to be helpful, because you're going to see all kinds of numbers that vary drastically. And so with the deal goggles, then you are going to be able to pick 1 or 2 markets that you're really going to do deal analysis, 1 or 2 asset classes that you're really going to drill down on, and 3 to 5 different strategic objectives that you're really trying to achieve. So, for example, for me in 2025, I'm only doing deal analysis on the 5 things. So I'm looking for properties that, number one, is financially distressed. So if it's not in foreclosure or lien or tax auction, I don't even want to look at it. I'm not interested because any deal that is not financially distressed is probably not going to pencil, and it's not going to be worth my time even looking at it. So I need to see a deal that's financially distressed. And that's why wholesalers, they specialize on finding distressed properties, right? But you can find it yourself as well, or you can tell people I'm looking for distressed properties. Number 2, I'm looking for deals that are turnkey. I'm not interested in value add or heavy value add or light value add because right now it's a little bit too risky in this market. And there's too many uncertainties. So I like turnkey. It's faster for our investors, for myself, to cash flow. I'm looking for not only conventional financing, I'm looking to do deals where I underwrite, where I put down 40% down, 50% down, because that's the only way I find deals that cash flow. Because if I'm putting 10% down, 20% down, it's not going to cash flow. And also, I'm more risk averse now. When I started, I was like, how can I get away with 5% down? Now I'm like, I want to do 50% down, 40% down, right? I'm also looking, every one of my deals, I'm looking to do accelerated depreciation. So what is that going to look like with those returns? And I'm ultimately looking for buy and hold. I'm not looking to sell in the next 5 years. Anything I buy in Sacramento and Davis, I want to hold for the rest of my life. And so with that in mind, you all want to think about your own investment thesis. And so I'm going to take a point of personal privilege. I am going to do this for the first time. George actually just went through this, but I am going to do next Wednesday, host a Zoom workshop. And it is going to be a 1-hour Zoom workshop where I'm going to go over investment thesis and how you can shape your own investment thesis and what my investment thesis is. And I'm also going to go over deal analysis with some real examples on actual deals and actually show you my deal calculator and go through the deal calculation process together. And it will be completely free. This is just as a courtesy for everyone who's here next Wednesday on Zoom at 6 o'clock at this exact time. And it's actually an 8-week e-course that we're going to jam pack into 1 hour. And because I realized, who has time for 8 weeks? So it's going to be 8 weeks of workshops. We're going to jam pack into 1 hour. And if you want to learn more, because you want to do more than 1 hour, you can download my book. So with that, thank you.
Thank you so much, Andrew. I think what you said about fundamental supply constraints is totally overlooked, and nobody ever talks about that. And it's really brilliant. It's an important factor, so I appreciate you sharing that with the group. And we'll do a quick Q&A if anybody has any questions for Mr. Andrew before we wrap up.
Thank you so much. That was a fantastic talk. Really appreciate that. But my questions for you, and now that with your new strategy that you're looking into it, how are you adjusting your financing perspective? Because we have been quite volatile market. So with everything you've spoken about, how are you incorporating that into your new strategy for 2025?
Very true. So we're very fortunate because we've had strong lender relations. So we've been working with Tri-Counties Bank, First Northern Bank, Five Star Bank for almost a decade. And so for them, and why I choose these local banks instead of the larger lenders is because the larger lenders, they don't really know how to underwrite or validate our rents, right? So our rents in Davis, if we went to US Bank or Wells Fargo, they would treat it like rent in Elk Grove. And I'm like, no, our rents in Davis are not rents in Elk Grove, but if they would just same broad stroke. And so for us, we, in order for us to get the same terms that we have with our current lending partners, we need to give them really good deals. We need to have a really strong deal narrative. So if you have a really strong deal narrative, that's important. Obviously, the numbers are important, but as you saw, the numbers can be fudged. And the lenders know that too. So they really need to see a deal narrative. They need to know your business plan. If they feel like your deal is strong, but no one is going to operate it well, like if you're going to outsource it or you're going to try to operate something you've never operated before, they're not going to give you good lending terms. But I think ultimately, to answer your question, it's deal by deal. And so I think certain deals I'm willing to take, instead of 7%, I'll get 7.2%, right? Because that 0.2%, yeah, 20 basis point, it hurts. But in longitudinally, as long as you do the sensitivity analysis and like that 20 basis point can be absorbed with just 1 year of rent increase, then it's not that big of a deal, especially if you get a 7.2 at a 20-year fixed. Or I mean, they don't do 20-year fixed for commercial, but like 10-year fixed, right? So I think the interest rate is not as important as you think, unless your deal is super interest rate sensitive. And I have worked on deals where like the cash on cash return just on a 20 basis points can jump from 4% cash on cash returns for investors to like 6%. And just so in that scenario, then we're going to fight to the nail to get a better terms. And if that means we need to do more than 50% down, do 60% down, we'll do that because our investors, we're now a lot more risk averse and we're looking long range. So I don't know if they answer your question.
Yeah, I think that answers the question. I'm just curious to see how you're underwriting in this kind of volatile market because the MBS is up and down this, the first half of this year.
Yeah, so how we're underwriting is we're spending way more time on the interest rate sensitivity analysis and just stress testing the numbers even more than before.
Awesome. Thank you.
So when you're talking about the return on investment you want, and you say you want to see a higher ROI in like Fresno, Stockton, in order to take that risk, I don't understand why that is since your ROI already considers your cash on cash returns, your anticipated appreciation, anticipated expenses. You should already be considering those by market, right? So is that just an emotional decision based off of the market, or why do you want to see a higher rate of return in those areas?
So when I got started in real estate, my very first few properties were in Fresno because I couldn't afford this area. So I started off in Fresno, then I moved to Modesto, then got properties in Stockton, and then I ended up selling all of those and ending up in Davis. The main issue, the main risks with these markets, I'll call them tertiary markets, right? So these tertiary markets, number one is operational risk. Right. So like the kind of tenants you get, the kind of like issues that you have to deal with are way more crazy than, something that I have to deal with. Like in hindsight, like right now, all of my 12 properties, I can drive to all 12 properties in less than 2 hours. And so whereas before, like owning a property in Fresno, in hindsight, I might as well just buy a property in Texas because like me going to Fresno, I might as well go to Texas. But so operational risk. Then number two is market risk. Although there is appreciation, and that is factored in, right? So Fresno appreciation would be way less than Davis appreciation and or Sacramento appreciation. That would be accounted for in the IRR. But fundamentally, I'm not concerned about appreciation as much as I'm more concerned about devaluing. So for example, and I mentioned this just a moment ago, right now we are in a market correction, right? Real estate property values, if you check your own properties on Zillow or Redfin, every time I go, I get like anxiety. So I stopped checking Redfin and because like all my property values keep going down and down. And that's the reality. This is the biggest market correction in real estate since the housing crisis, right? Since at least the pandemic, right? Property values are really low. This is the cheapest time to buy a property, but it's also, financing is still high and there's a lot of market uncertainties. And that's why it's a very interesting buyer's market. If you're all cash buyer, this is a perfect time to buy, right? But what communities got hit more? The tertiary markets. Fresno right now, definitely down 10%. Modesto also down 10%. Sacramento is down 2%. 2%, very recoverable. 10%, that's like, I don't know, like if you owned a property for 30 years and it just dropped 10% in value on your sale price, like you're gonna really feel that pain. It means you're doing $50,000, $50,000 to $60,000 what's called a price reduction, right? That's what's happening. We're seeing $60,000 price reductions in Modesto and Fresno. In Davis, there's no price reductions. I mean, they're not increasing the price, but it's still maintaining. And so for me, as as your portfolio evolves, I moved from like risk on markets to now risk off markets. And because I think it goes to first principles, which is not losing money. And if I'm going to be in a market where I'm going to lose 10%, I might as well just buy Tesla stock. And so for me, like, that's why I believe in, these stronger markets. But there's also a caveat to that too. I'm not buying in El Dorado Hills or Granite Bay or Roseville, which are nice property value markets, because they also don't have strong rent growth, right? And so because nobody's moving to El Dorado to live in an apartment complex. Thank you for the question.
All right. Thank you so much, Mr. Andrew Kim. And we're gonna wrap up. Sean's got some words of wisdom for us, my old sage friend.
I just want to encourage people who are new. It's kind of scary to start. If you don't dare to start, if investment is completely new to you, mingle, network, maybe do it with somebody, right? In order to change, you have to try something new. If you keep doing the same thing, your life is not going to change. To get a new life, you have to do something new. All right. So you want to do things that are hard, and your life will become better. All right. If you keep doing things, take it easy, and your life is going to remain hard. So bite the bullet and do it with somebody, and you're going to see that real estate is great. All right. Thank you, guys.
Thank you guys. We're just gonna hang out for the rest of the night. Appreciate you guys coming. Thank you.